Welcome, students. Settle in and grab your notepads. Today, we're going through this explainer at a deliberately slow, clear, and measured pace because we're tackling Chapter 19, Property Businesses. We're focusing strictly on the Finance Act 2024 to get you completely ready for those 2025 exams. This is a massive, highly interconnected topic that examiners just absolutely love to test, so absolute clarity is our #1 goal today. Okay, here's our roadmap. We're going to look at the property tax landscape, allowances and reliefs, finance cost restrictions, furnished holiday accommodations, and finally, the big incorporation decision. Keep the government's deliberate shift against buy-to-let landlords in mind as we go. It's kind of the invisible hand guiding all these rules. Section 1, the property tax landscape, setting the macro backdrop. Understanding the government's drive to squeeze buy-to-let investors is literally the key to mastering these exam scenarios. Just look at this number, 3%. That's the stamp duty land tax additional surcharge on residential properties. When an individual buys a second home or any property beyond their main residence, bam, this extra 3% gets slapped onto every single rate band. It's a deliberate hurdle, pushing effective SDLT rates up to a staggering 15% on portions of the purchase price above £1.5 million. Now, once you actually own the property, you've got to compute your property income, right? Usually this is done on an accruals basis. You can only deduct strict allowable expenses from your gross rents. We're talking insurance premiums, letting agent and management fees, property-related accountancy fees, general repairs and maintenance, and stuff like council tax and utilities, but only if the landlord actually pays them out of pocket. And here is a classic exam trap you really need to watch out for. You have got to meticulously distinguish between a deductible revenue repair and a non-deductible capital improvement. Think of it like this. If you replace a broken window with the exact same type of single-glazed window, that's a repair, fully deductible. But if you upgrade it to double glazing, that's an improvement. It's capital expenditure, and it is strictly forbidden to deduct that against your rental income. Moving on to Section 2, Allowances and Reliefs, specific exemptions for landlords. Let's see how the rules offer a few lifelines, provided you meticulously tick all the statutory boxes. £7,500. If your client lets out a furnished room inside their own main residence, and yes, it absolutely must be their own home, they can claim renter room relief. This is a highly testable annual exemption of exactly £7,500. If the gross rents are below that, the income is completely exempt. You don't even need to report it. But what if the rents are over £7,500? Well, you face a choice. There's the normal method, where you deduct actual allowable expenses from your gross rents. Or there's the simplified method, paying tax only on the excess above that $7,500 threshold. For your exam strategy, remember this. Taxpayers can mathematically pick whichever method gives them the lower tax bill. But, and this is huge, you cannot mix and match the simplified method with actual expense deductions. Similarly, for general property income, say renting out a separate flat, there's £1,000 property allowance. It's a gross income exemption. Again, it's an either-or situation. You either use the allowance and deduct zero actual expenses, or ignore the allowance and deduct your real expenses. It's super simple to operate, but only beneficial if your client's actual expenses are strictly below that £1,000 mark. So what about furnishings? Well, for fully let residential properties, capital allowances on furniture are completely off the table. Instead, you calculate replacement furniture relief. You do this by taking the cost of the replacement asset and subtracting any proceeds from selling the old one. But listen closely. You must strictly use the cost of an equivalent asset. If a landlord decides to splurge on a fancy, upgraded sofa, you only deduct the cost of a basic, like-for-like replacement. The upgrade cost, completely ignored. Right, Section 3, Finance Cost Restrictions, the major hurdle for individual landlords. I need you to pay very close attention here because this is highly testable in complex scenarios, and it's the absolute cornerstone of the government's anti-landlord policy. The rule is pretty severe. Finance costs, like mortgage interest or loan fees, on residential lettings by individuals are not deductible as an expense, period. As an individual residential landlord, your client has to declare their gross rental income in full, without deducting a single penny of their mortgage interest from that top-line figure. Instead of an expense deduction, they get a flat 20% tax reducer. This happens right at the very end of the income tax computation, at step 6. The impact here is massive. It literally doesn't matter if your client is a higher or additional rate taxpayer paying 40 or 45%. They only ever get a 20% reduction for their finance costs. Now, who actually escapes this restriction? Well, companies do. Furnished holiday accommodation businesses do, but only for the 2024/25 tax year. Commercial property lettings and property developers are also exempt. Here's a massive exam strategy tip. Always check the entity and property type first. And beware of the personal allowance tapering trap. Since you can't deduct finance costs, a landlord's adjusted net income looks artificially higher. If that pushes them over the £100,000 threshold, they get hit with a brutal 60% effective marginal tax rate. Ouch. Section 4, Furnished Holiday Accommodations, the expiring cheat code. For years, the FHA regime has been a veritable tax cheat code, but as you'll see, its days are definitely numbered. To get FHA status in the 2024/25 tax year, a property has to jump through 3 very specific sequential hoops. First, it must be available for commercial letting for at least 210 days. Second, it must actually be let commercially for a minimum of 105 days, and that strictly excludes any personal use by the owner. Third, any longer-term occupation, meaning someone staying over 31 days, cannot exceed 155 days in total. If you manage to perfectly hit those conditions in 2024/25, the benefits are incredible. The income is treated as trading income, which means it counts as relevant UK earnings for pension contributions. You get a full mortgage interest deduction, completely bypassing that restriction we just talked about. You can claim capital allowances on furniture. And best of all, when you sell, it qualifies for business asset disposal relief, slashing the capital gains tax rate to just 10%. But here is the ultimate exam scenario. Check the transaction date. 2024/25 is the final year of the party. On April 6, 2025, the FHA regime is officially dead. So if your client sells on or after that date, they completely lose that 10% rate. The property just defaults back to the standard residential CGT rates of 18 or 24%. Finally, Section 5, the incorporation decision, weighing the ultimate tax strategy. This is the big structural question clients will ask you. Should they transfer their property portfolio into a limited company? Since companies completely bypass that harsh finance cost restriction, highly geared landlords are super tempted to incorporate. But as an advisor, you've got to do the math. You have to carefully weigh the long-term corporation tax savings against the brutal immediate transfer taxes. You're looking at an immediate SDLT hit based on the open market value, an immediate capital gains tax charge, and later down the line, income or dividend taxes when they actually want to extract those profits. Now, you can mitigate that immediate capital gains tax hit using Section 162 incorporation relief. But, and it's a big but, you have to prove the portfolio is a genuine business. This comes down to a famous legal precedent called the Ramsey case. It sets a strict benchmark. The owner must spend about 20 hours a week actively managing the properties. Just sitting back and passively collecting rent? Yeah, that's going to fail the test. Also, while multiple dwellings relief was recently abolished, you really need to remember this SDLT partnership exemption. It is highly testable. Basically, if genuine spousal or family partners transfer a property business into a new company where they are the only shareholders, the SDLT charge is zero. Literally zero. That can save your clients an absolute fortune upfront. But you can't just look at the start. You have to warn your client about the end game. Getting the money out later triggers a painful double layer of taxation. Layer 1, the company itself pays corporation tax on any property gains when it sells an asset. Layer 2, the individual then gets hit with capital gains tax when they eventually sell their shares or liquidate the company. It's a massive double tax on exit. So I'll leave you with this crucial scenario to test your recall. When your client excitedly asks if they should incorporate their buy-to-let portfolio, what 2 major unavoidable tax costs must you immediately warn them about? Always, always remember to calculate the market value SDLT and the potential capital gains tax before giving the green light. Remembering that is exactly what separates a passing exam script from an exceptional one. Study these concepts carefully, and best of luck with your preparations.